Greetings, my name is Doug Cooper, Senior Portfolio Manager at Empire Life Investments. The purpose of this video is to highlight Intact Financial, which has been a successful investment for us across Empire's Canadian large cap mandates over the past year and a half or so. So I want to do a couple things. First, I want to talk about what we like about Intact Financial, and then I want to highlight what gave us a conviction to buy Intact when investor sentiment was extremely negative. So what do we like about Intact? Intact has a commanding market share of the property and casualty, or P&C, insurance industry in Canada at about 16%. Its next biggest competitor has a market share of about 10%. As a result, Intact benefits from a material scale advantage in terms of underwriting as well as distribution, which has allowed the business to consistently generate returns on equity above its peer group. We also really like the management team at Intact, including the CEO, Charles Brindamour, who has generated a very good track record of capital allocation and growth while he's been CEO over the past 10 years plus. So armed with what we view as a sustainable scale advantage, with Intact operating in a relatively fragmented P&C insurance industry in Canada, we believe that Intact has highly visible and attractive growth prospects. So bottom line, Intact is a high quality business. It has all the attributes we look for, including very strong competitive positioning, attractive growth prospects, a very good management team, and also a strong balance sheet. But anybody can invest in a high quality business. It's really about investing in a high quality company at an attractive valuation. And let me explain. So in the back half of, or towards the end of 2017, investor sentiment had become quite negative towards Intact as a result of rapidly increasing auto repair costs from technology and sensors becoming a larger part of the car. So as a result, Intact's valuation and stock price came under quite a bit of pressure in the first half of 2018. So taking a longer term view and having a deep understanding of Intact's business, we understood that management had a number of levers to pull to offset these cost headwinds, including price increases, as well as further optimization of the claim process. And we also had very, very high confidence that management would execute on these initiatives. So in the back half of 2018, Intact began to report better than expected results in terms of profitability, and then the market began to further anticipate additional improvements in sales growth as well as profitability, which management eventually delivered on in the subsequent quarters. So as a result, Intact's valuation expanded significantly from about 13 times price to earnings in July 2018, when we started to aggressively buy Intact, to about 18 times price to earnings today. So as a result, the stock price had appreciated by about 50% since July, when we started buying Intact. So taking a different view than the market, fueled by a very deep understanding of a business, and taking a longer term view and a very disciplined approach to valuation is an integral part of Empire's investment approach. And Intact is a great example of this investment approach in action. And it's also a great example of how we are adding value for our unit holders. Thank you very much for listening.